Louis Freeh is the former FBI director and current trustee for the MF Global bankruptcy case. Freeh has announced plans to pay $1 million in bonuses to Bradley Abelow, MF's chief operating officer, Laurie Ferber, the general counsel, and Henry Steenkamp, chief financial officer of MF Global. And they could make more if salaries and other incentives are improved. You may recall that MF Global lost more than $1.6 billion in customer funds that were supposed to be segregated, completely safe. Nobody's been able to find the money. Last we heard, money had just vaporized. Now, it's not easy to make $1.6 billion just disappear. It requires enormous incompetence or gross negligence or truly evil intent. Meanwhile, Louis Freeh used to run the FBI, and you wouldn't think the man was a blithering idiot, but apparently he is. Apparently, the entire system has been so thoroughly and totally corrupted that we just can't fathom the possibility of common sense. It's either that or the Earth is hurtling off through the cosmos. And the simple truth is that the Earth is still on its normal orbit around the sun, but everything else is a little crazy. Financial institutions are stealing and pillaging, and regulators have become facilitators. It's happening almost everywhere. The prevailing theme is that financial institutions have been gaming the system and corrupting the marketplace. A criminal investigation into suspected manipulation of benchmark interest rates is being conducted by the U.S. government. This, according to a letter to a federal judge in Manhattan, that letter made public last week. It's the first public acknowledgement by the Justice Department of the criminal investigation of benchmark lending rates such as the London Interbank Offered Rate, the LIBOR rate. This is the rate that's used for everything. There's a good chance if you have a mortgage, it's based upon the LIBOR. And it's been manipulated. The judge denied a request for documents related to the investigation by investors suing Credit Suisse and Bank of America and other companies over claims they artificially suppressed LIBOR. According to the letter signed by lawyers from the fraud section of the Justice Department's Criminal Division and its Antitrust Division, quote, the Department of Justice is conducting a criminal investigation into alleged manipulation of certain benchmark interest rates, including those for several currencies on the LIBOR exchange. Here's another example. State court judge in San Francisco just ruled that Goldman Sachs and Bank of America need to make public documents that had been deemed confidential in a lawsuit filed by Overstock.com. The case involves a 2007 lawsuit by Overstock, the online retailer, claiming the banks manipulated its stock from 2005 to 2007, causing shares to fall. The state court judge dismissed the case in January, ruling that the conduct took place outside of California. Overstock appealed, asked the judge to make public those documents he put under seal. Overstock claims that large portions of its stock was the subject of naked shorting, where investors sell shares they don't own in anticipation of making a profit by paying for the stock after its price has fallen. The clearing operations at Goldman Sachs and Merrill Lynch, that was the brokerage that was acquired by Bank of America in 2009, the clearing operations intentionally failed to locate and deliver borrowed shares for clients, allowing the firms to earn fees and interest on phantom securities transactions. Lawyers for Overstock made this case in court filings. Overstock sought millions of dollars in damages against Goldman Sachs and Merrill. They just can't do business the right way, can they? Now, remember last week when we talked about nearly 200 banks that repaid their TARP bailouts with funds from other federal programs. And then what about the situation in Europe, where more than $1.5 trillion have been handed over to the Eurobanks in order to resolve the debt problem with Greece, which never had more than a $260 billion debt problem to begin with? Kind of like using a bazooka to swat flies. Oh, and in the process, what happened? Democracy in Greece gone. But wait, there's more. Remember the $25 billion multi-state mortgage settlement? It was officially filed in court today. HUD Secretary Donovan claimed he had investor approval to do the mortgage modifications that are a significant part of the value of that settlement. Now, we'll eventually see what is actually in the settlement, but early on, Donovan claimed that no less than $10 billion of the $25 billion headline total was to come from principal reductions, modifications of mortgages not owned by banks, meaning in securitized trust, would be counted as 50%. And then before Donovan realized the math didn't add up, he said he expected 85% of the mods to be from securitizations. So that means $17 billion. Bear in mind, none of it's real. Investors, analysts, and commentators have objected to the very premise of the arrangement. A settlement involves a release of liability, and in anything other than the through-the-looking-glass world of rule by banks, the party that did the bad stuff is the one that pays for the settlement. But that doesn't happen anymore. Ever since the meltdown of 2008, the banks realized that profits were private, but losses could be socialized. They could slough off any sort of trash and toss it onto the general public, and we wouldn't do anything. Recall how sanctimonious Tim Geithner has been about not breaking contracts such as the AIG credit default swaps agreements and employment contracts with AIG staffers? And do you remember how Payzar Ken Feinberg excoriated bankers for the bonuses they took out of firms that they blew up but refused to try to claw back pay because it might lead to lawsuits? Now the railroading of investors may not seem all that important to many of you, but you are in fact exposed. This is a direct subsidy from taxpayers to the banks. And more important, if investors are, for the most part, too afraid, too compromised, or too plain lazy to take action against banks and will sit passively as their contracts are violated, what hope is there for ordinary, less well-connected citizens? The multi-state mortgage settlement and the MF Global bonuses and the short-selling speculation all lends credence to the idea that contracts in America have become decidedly one-sided affairs. The banks take advantage of every trap. Then they heap abuse on top of abuse. After vaporizing $1.6 billion, the executives of MF Global pile on the abuse with a request for $1 million more. Hat in hand. The great analogy that I heard today was some guy gets drunk and goes driving and totals the car. And so what do? We give him the keys to the tow truck and tell him to tow the car away in the tow truck. He's still drunk, stinking drunk, and we give him the keys to the tow truck. Oh, and then we give him an extra $50 and say, pick up some beer on the way. Welcome to the MF Global world. Welcome to the banks and the authorities that seem remarkably unaware of what they are doing in undermining the rule of law, which is critical to resolving disputes peacefully in a complex and sometimes combative society. They're likely to find that undermining the protective role of the judiciary will leave them more exposed than they could possibly imagine. Yeah, just what we need. Bonuses for MF Global. On Friday, we had a couple of big economic reports, the monthly jobs number and the trade deficit. They're connected, actually. The headline news on the jobs front was that the economy added 227,000 jobs in February. And we've talked about this number before. We've talked about the birth-death model for calculating jobs, and we know the numbers get skewered one way and twisted another because the numbers are based on assumption. We know that the number on Friday was probably off. How much? Was it 20,000? 50,000? We simply don't know. So we stick with the official number and an uneasy feeling about the veracity of the number. So we know that the number isn't really right. But let's look at the kind of jobs that were created. Of the new jobs reported by BLS, 92% are in services. Of this 92%, only 7% could possibly relate to exportable services, architectural, engineering, computer systems services. That's a little bit of a stretch, but of the reported new service jobs, 29% are in healthcare and social services. The categories that account for the health services jobs are ambulatory healthcare services and hospitals. Waitresses and bartenders account for 20% of the reported new jobs. Employment services account for 29% of the new reported jobs. Transportation and warehousing, 5% of the reported new jobs, despite a loss of 60,000 jobs in general merchandise and department stores. So in other words, the vast majority of new jobs are low-paying jobs, except for maybe a few truck drivers. Other conclusions that we can draw are the U.S. has nothing to export to reduce its massive trade deficit, which has, sooner or later, it has disastrous implications. Disastrous in terms of inequality. In the 2010 recovery, 93% of the gains were captured by the top 1%. That's because top incomes grew 11.6% in 2010, while the incomes of the 99% increased 0.2%. And that gain is particularly painful because it comes after an 11.6% drop in the income for the 99%. The largest such fall over a 2-year period since the Great Depression. That decline more than erases the income gains since the last downturn. We may not yet be a lost generation, but we have certainly experienced a lost decade. It's understandable given the number of times green shoots have been seen since the downturn began in December 2007. It's understandable that there might be some skepticism about claims the recovery is finally underway. The question is, what does it imply for policy? Does it mean we can be more relaxed about the demands for austerity, or that the Federal Reserve should start paying more attention to inflation and begin contemplating raising interest rates? Even if this is not one of the many green shoots that soon turn brown, the economy will almost certainly need some more stimulus if it's to return to full employment anytime soon. This is the inevitable conclusion from looking at the state of the labor market today. It's a shambles. Today, the American economy faces at least 4 big risks. First, a steeper European downturn. This is a result of the excess austerity and the euro crisis. Even if we avert a meltdown in Europe, there's still the long, hard slog of a euro depression. Second, complacency, that the economy will just recover on its own. Every downturn comes to an end. That should not be of much comfort. We need to take some definite steps to dig ourselves out of the hole we're in, and that generally points to investing in ourselves. Third risk is that we accept that an unemployment rate above 7% it's inevitable. It's the new normal. But this is incredibly risky. High unemployment must never be accepted. This is not the path to prosperity. And then the fourth risk is that we start to think that some people are above the law. In other words, we have to throw some bankers in jail